Welcome to our weekly video. This is the third week we're doing this. It's all about the COVID-19, and as I was telling Wayne, I look forward to us not doing these videos, but I think we're going to do them for a while. As Jay Powell says, the virus is going to dictate the time frame, and it takes time. This week seemed like a pretty calm week. Wayne, what did you think?
Still exciting. There's a lot of volatility, but we're seeing some stability in places. I've been talking about value sort of making a bit of a comeback, actually getting really hurt badly in the first quarter. It's been kind of flat versus the rest of the market, value stocks, for the past about 10 days. So we're seeing some trading within the market, which is actually a good sign. And we saw, of course, oil bounce this week, which was a nice, some hope there at least. So we're seeing, and also, the U.S. 10-year Treasury is sort of getting down to around 60 basis points, sort of stuck in a range there too. So we're getting some stability, here's what I'm saying, which is actually less volatility, and so we're happy about that.
Right, right. You ended last week our video saying your job next week would be to be vigilant in the portfolio and make sure you ferret out any problems. Talking to Andrew on your team, said nothing happened this week, so we didn't see any problems that were worthy of kicking somebody out.
Yeah, anything, we shaved a little bit of real estate here and there. Still concerned about real estate given what's going on out there. You've heard problems that are going on with WeWorks, and WeWorks are cutting rents in half, for the remainder of this year, kind of thing. So there's going to be dislocation there, and the fact that governments, provinces, states, municipalities, their revenues are cratering. So there's issues out there and from that perspective. So we're concerned about, I guess, real estate and financial at some point in time, but we've seen some good signs this week when it comes to liquidity and the Fed getting involved in those markets.
So Wayne, everybody I read and listen to that I respect, including you, talks about the three phases of a panic event, having a panic market, which we did in the latter half of March, and then the bounce that we had at the end of March, and then the retest. And so it seems everybody has these three phases that they're talking about, which makes me think that we're either not going to get a retest, or the retest is going to be super ugly. So what do you think?
Those are out there still. Like everybody I've heard on all the talking heads on the financial media this week have talked about the retest and going lower than the retest. And nobody's talking about a V-shaped recovery, which is still a possibility. It's a probability. I'll give that maybe 25%. It's a possibility. It happened actually in in China, about day 34, and we're about day 27, 28 right now. And it had happened 3 days prior to the peak in their daily cases. So I still think that the market is going to look through the coronavirus issues right now. I think there's getting a handle on that in terms of modeling, and it's more concerned about the credit issues. Some of those were alleviated this week, but the economy in the past has never just been stopped for 2 or 3 months and then rebooted. So we don't know what's going to happen here, and I think that's concerned about the market. Is going to cause some accidents along the way. The numbers that came out this week, the PMI numbers in the U.S. were actually better than expected. Chinese PMI bounced back to 46 from 32, so it's looking not bad in China. If you use China as a model, how we come out of this, it's not going to be bad. But there's going to be a second wave probably this fall, and some businesses are not going to come back. That's a fact. I
think we're also going to get a lot of noise. Right now, they're very happy that the governments are giving out all this money, but getting the money into the hands of the people. Right. We're going to hear in the coming weeks of more and more frustration on the part of workers not getting their money.
Right. And I'll say it again, this is very different from other recessions and crises in that there are some big winners in this space. Like Walmart can't hire enough people right now. Amazon's winning. Right. And Microsoft,
like 80,000 of the 100,000 they want.
So it's very different. They really haven't, as I said last time, they really haven't shot the generals yet. The generals they've underperformed. Obviously, that they're getting hit. We're seeing that social media giants like Google and Facebook are going to get ad revenue hits because people aren't going to spend money on advertising. but it's not that bad. And so, and I believe that too, coming out of this, the acceleration to the digital economies is going to accelerate even faster, and we're not going to go back in a lot of different ways here. So there's going to be big winners and some big losers in this here, and I think the winners might help hold this whole thing up here. And so far, so good. In terms of the numbers in the economy, they're just going to be very ugly. We're talking about unemployment somewhere around 12 to 15%, and then dropping, and then the economy probably might.
Again, these numbers aren't comparable to any point in time where we've had unemployment numbers, because never has the demand stopped so abruptly. So
yeah, and the thing here too is that 2008 was a long grinding process for almost 2 years, where you just got beaten down every day, and there was all these problems out there. We're here, we're talking about turn the engine off and then reboot it 2 months later. So
right.
It's going to be very different. And the question is, when will the market look through the carnage on the streets, the credit problems? I just want to say there's been some good news this week on the credit side. That the Federal Reserve has, and thankfully they went through 2008. They're making a difference here. The monetary base is up $1.5 trillion in the past 10 days. U.S. bank reserves were 1 trillion prior. They're now 2.7. So the banks are that's helping the U.S. banks. The repo market's really working well. The commercial paper spreads were blowing out 200 basis points. They're now about 125 basis points. So we're seeing improvement there as well. And you know what? In some ways, the banks are going to be a bit like the utilities just go around, because they're going to be the one doling the money up to small businesses. And they're going to make money on that. Like JP Morgan made a lot of money in 2008 because they were helping clean up the asset-backed problem. So I think that'll help the banks to some extent. And they went in, with good balance sheets in the U.S. at least. And today or yesterday, T-Mobile raised $19 billion in the credit market, in the bond market, at 3.5%. So things are going on here, and it's in spite of all the scary things we're seeing in terms of the virus, people being laid off, and there's liquidity is definitely out there, and the Fed will keep standing in front of that marketplace.
I want to come back to the clients for a minute. We're not going to do the normal quarterly video because we're doing these, but I'm going to use a moment here to talk about the quarter in hindsight. So it was, of course, devastating quarter. The Toronto Stock Exchange down 21%. And the bond market was so bifurcated, with the government bonds being up 3% and corporate bonds, good quality corporate bonds, being down 2%. Again, that flight to safety happening. So our accounts are down about 10%. Depends. You might be down more if you had more equities, and less if you had less. And you're down less if you were fossil-free impact clients. But I just want to say, I did some homework myself looking behind the moves that our investment team did, and it was an extremely dynamic quarter for the trading in the portfolios. And maybe Wayne, do you want me to summarize the big picture? Do you want to go ahead?
Well, you can just go ahead, and I'll jump in, Leslie. I'll add some.
So what struck out to me is throughout the quarter, energy got reduced by 4.5%. Financials by 6%, healthcare stocks were increased by 4%, and technology stocks were increased by almost 6%. So those are big changes in one quarter for Genus. We don't usually move around that fast. But what was more revealing of what happened in the investment department is I arbitrarily chose March 5th as sort of the time where we were waking up that this has escaped China and was going to be a global problem. And you can see the investment team having bought real estate in the beginning, from December 31st to March 5th, turning around and selling 3% real estate, buying gold, selling consumer discretionaries to buy consumer staples. So I've never seen this kind of action out of our investment department. So I just thought I'd compliment you, Wayne, at getting a grip quickly what was happening. Nobody knew what was happening, but understanding the direction of where we were going. Well, so it ended up not being a bad quarter, of course, but it could have been much worse.
It could have been much worse. We started this quarter being very bullish. Our stock models, our macro models were turning very positive on the economy and positive on the market. And we thought we were in for a very good 2020. And we were positioned for a stronger economy. The sales were up, and we had we thought value would turn around this quarter as well. So we had a lot of value in the portfolio, and we had economic sensitivity in the portfolio, and we were hit by the virus hard. And so, as Leslie mentioned, we did a lot of rotations to try and make it back. And so we managed to salvage the quarter, I can say. I wish, we would have done a lot better if we weren't so aggressive going in, but we did some quick turns. We just looked at where the problems were and where this thing was going, and said, let's go. And we went into technology and healthcare and consumer staples, and even dipsy-doodled in the real estate, because we saw the problems manifest there. So, we're a smaller firm, we can act fast, and we did. And I think that saved our quarter.
Yeah, and of course the new U.S. government bond fund was very helpful also. So I want to get to some questions that we've had come in, Wayne. What I missed last week was somebody asked the impossible question is, so I have cash, when do I invest? And I would first, before you answer it, Wayne, I just have to say, I hate to be so boring, but the answer is always the same. It's let's create a plan. What is the time frame for this money? What are the income needs for this money? What are your other assets? And what is your emotional makeup when it comes to handling volatility? And once we get a grip on all those things, then we have a plan. And then Wayne, once we decide, say you want 60% equities, what would you do today if somebody like me created a plan for somebody and then it had to go to work?
Well, I would start putting some work today. Like, I wouldn't go 60% if you had 60% target long-term mix. I would say get 20% in right now and start dollar cost averaging in over the next 2-3 months, I think. And like, you might get this chance could go away very rapidly. You might get another chance to buy high quality companies at this point in time. You may never see that for a long time. So
and I would even say, if your portfolio manager has done a good job, you should go to halfway in right away, because the risk to long-term assets is not being invested.
Right.
So I would be more aggressive than the 20%. But there is no answer. There you show. Two people have been in the markets a long time. There is no answer to that. But slowly might be the better answer.
And get some in there now, too, is the key thing, too. Don't sit around waiting. Finding the very bottom of the market is an impossible task. And that's why we started rotating from fixed income into equities. And it wasn't a big shift, but we're starting to make the shift. And we'll do more over time here. But it's very hard to pick those bottoms. So just dollar cost average through it.
So another tough question. Canadian dollar was at 76 cents December 31st. It went down to 69 cents a short while ago. Now it's at 70 cents. What do you see for the Canadian dollar? I still wouldn't load up on the Canadian dollar here. There could be more downside. I'm not convinced the oil market's going to turn just yet, and it's really tied to that. And our economy in Canada is tied to two things: oil, and really it's been driven by real estate. And real estate has some issues right now. So I'm still, I want to do a further look at our models, but I'm still concerned about both those things. And so I would say I would take my time getting back into Canadian dollars at this point in time. I think at some point in time, though, and I'm surprised how well it's been held. It's holding here around 70 cents right now, and it's been flat for the past week or so. The fact that they're pumping, the Fed's pumping so much money, there's so much money out there, and Canada will get going once the global economy gets going. And Germany and Canada have the two biggest trading sectors as a percentage of their overall GDP. So that's an issue for Canada as well. So I would take my time here on Canada, is what I'm saying. Yeah. So I want to keep these short, of course, so I think we'll wrap this up. But I just want to end with talking to myself as much as everybody else. But I read the other day that there's to really make good decisions, you need to be self-aware of the difference between the word fear and the word danger. And we are well aware at Genus that this virus represents real danger, and we are rationally and calmly trying to address that danger in your portfolios. But I suffer from fear from time to time, and it is the enemy of dealing with danger. And so I just say to all of us, remind ourselves when we're in the fear category and when we're in the rational category of dealing with danger. And I can tell you the middle of the night is when it is irrational fear, and you need to turn on your light and read those next 2 chapters of your fiction book and go back to sleep and think about it in the morning. So with that, I just assure you that our investment team is calm. It's got great people behind them, and we know this is dangerous, and we're dealing with it. So thanks very much, and we'll see you next week.